Stop everything. What I'm about to show you was just confirmed 3 days ago, and it changes everything you thought you knew about the silver market. China isn't just restricting silver exports anymore. They've weaponized a $125 premium on physical silver inside their borders. And that premium is literally sucking metal out of American vaults at a rate of over 3 million ounces per day. And here's the part that should terrify you. President Trump just responded with threats of 100% tariffs, which means the US government knows exactly what's happening and they're scrambling to stop it. But they're already too late. Right now, as I'm recording this on January 30th, silver is trading at $120.71 per ounce in New York. But in Shanghai, in China's domestic market where only Chinese buyers can access it, that same ounce of silver is valued at $125 to $126. And this isn't some temporary glitch or market inefficiency. Silver leaving COMEX vaults in the past 2 weeks alone would have been unthinkable 6 months ago. Before I break down exactly how this works and why you need to act immediately, I need to know I'm reaching the right people. If this information is valuable to you, hit that subscribe button right now and turn on notifications because this story is moving fast and you need to stay ahead of it. And drop a comment below telling me what state you're in and what the time is where you are. I want to know how far this message is reaching, because what's happening right now is a global event that most people won't understand until it's already over. Now let me show you something that's going to make your jaw drop. When China implemented their export licensing system on January 1st of this year, they didn't ban silver exports outright. That would have been too obvious, too aggressive, and it would have triggered immediate retaliation from the United States and Europe. Instead, they did something far more sophisticated. They restricted exports to only 44 approved companies, which immediately created a supply squeeze in their domestic market. And when supply gets tight and demand stays constant, what happens to price? It goes up, way up. But here's where it gets brilliant. And this is what most analysts are missing. The premium between Shanghai's domestic price and London's international price isn't an accident. It's not market forces gone wild. It's a calculated strategy that creates what's called an arbitrage opportunity. And that arbitrage is functioning like a vacuum cleaner, pulling physical silver from Western vaults into Chinese hands at a pace that should alarm every person watching this video. Let me explain how this arbitrage works because it's critical that you understand the mechanism. If you're a major metals dealer or a large institution, you can buy silver in London or New York at the international price. Let's call it $120. You then ship that silver to Shanghai where it's worth $125 or $126. That's a guaranteed profit of $5 to $6 per ounce. And when you're moving millions of ounces, that adds up to tens of millions of dollars in profit. So what do you think is happening? Every major player who can access both markets is buying in the West and selling in the East as fast as they possibly can. And where does that Western silver come from? It comes from the COMEX vaults. It comes from the LBMA vaults in London. It comes from the very storage facilities that are supposed to back all the paper silver contracts that millions of investors think they own. The data on this is absolutely stunning. As of January 27th, COMEX registered silver, that's the metal that's actually available for delivery, has been draining at a rate of 3.26 million ounces per day. Per day, do you understand what that means? At that rate, the entire deliverable inventory of silver in the COMEX system could be gone in a matter of months. We're not talking about a slow decline over years. We're talking about a structural collapse happening in real time right now, while most people are completely oblivious. And this is where the historical parallel becomes impossible to ignore. Does anyone remember 1973? If you're over 50, you lived through it. If you're younger, your parents definitely remember it. That's the year OPEC, the Organization of Petroleum Exporting Countries, decided to use oil as an economic and political weapon. They didn't stop producing oil. They didn't stop exporting it entirely. What they did was restrict supply enough to quadruple the price, and in doing so they brought the entire Western world to its knees. Gas lines stretched for blocks. Inflation exploded. The stock market crashed. Economic chaos spread across every developed nation that depended on Middle Eastern oil. What China is doing with silver in 2026 is the exact same playbook, except they're using the mechanisms of capitalism itself to execute it. OPEC restricted supply and raised prices directly. China is restricting exports and letting the market create a premium, then using that premium as a magnet to pull metal out of competitor nations' reserves. It's economic warfare dressed up as free market dynamics, and it's devastatingly effective because by the time most people figure out what happened, the metal is already gone. Now here's where the Trump tariff threats come into the picture, and this is recent news from just days ago. On January 14th, President Trump issued a proclamation under Section 232, declaring that the import dependence on critical minerals, including silver, constitutes a national security threat and a national emergency. That's not my characterization. That's the literal language from the White House. National emergency. Let that sink in. The United States government has officially declared that silver supply is a national security issue. And then, in the days following that declaration, Trump threatened Canada with 100% tariffs if they make certain trade deals with China. Now on the surface, that looks like it's about Canada and general trade policy. But if you connect the dots to the Critical Minerals Emergency Declaration, what you're really seeing is the U.S. government trying desperately to stop the outflow of strategic materials to China. They're trying to close the barn door, but the horses have already left. The silver is already flowing east at an unprecedented rate. And short of military intervention or a complete lockdown on exports, there's not much they can do to stop it now. Let me give you some more proof that this is a coordinated strategy and not just market chaos. The premium between Shanghai and London silver hit $17 per ounce on January 27th. $17. That's a 14% premium for the same metal in a different location. In normal commodity markets, that kind of spread would be arbitraged away almost instantly. But it's not going away. It's persisting day after day, week after week, because China is maintaining their export restrictions to keep that domestic supply tight. Every time metal tries to flow into China to close the gap, it gets locked up behind the 4-4 company licensing wall. So the only way metal is moving is from west to east, never the other direction. It's a one-way valve, and it's draining Western reserves at a rate that would have been unthinkable a year ago. Now I need to talk about something that most silver investors don't think about until it's too late, and that's the difference between paper silver and physical silver. This is the fourth time I'm going to emphasize this point in this video because it's that important. If you own shares in a silver ETF like SLV, you think you own silver, but what you really own is a claim on silver that's supposedly sitting in a vault somewhere. And when that vault is being drained by arbitrage to feed China's premium, what do you think happens to all those paper claims? They become promises written in disappearing ink. The iShares Silver Trust, the big SLV fund, has been reporting changes in their holdings. And while they've actually seen some inflows from retail investors piling in, the physical silver backing that fund has to come from somewhere. And if the COMEX system that feeds these ETFs is being drained faster than it can be replenished, you're going to reach a breaking point where redemptions can't be honored in physical metal. They'll offer you cash settlement at whatever price they determine is fair, which is another way of saying you're going to get screwed. There's a reason the Sprott Physical Silver Trust, ticker PSLV, just announced on January 20th that they're expanding their equity program to raise up to $2 billion to buy physical silver. $2 billion? They're not doing that because they think silver is going to go down. They're doing that because they see what's happening with supply. They understand the arbitrage dynamics. Trends continue. Every day, millions of ounces of silver continue flowing from COMEX and LBMA vaults to China. Every day, the registered inventory that backs the futures market gets smaller. And every day, more investors wake up to what's happening and try to convert their paper claims into physical metal. What you get is a feedback loop, a squeeze that feeds on itself. As supply gets tighter, prices go higher. As prices go higher, more people try to take delivery. As more people try to take delivery, supply gets even tighter. This is how markets break. This is how you get force majeure declarations where exchanges say, sorry, we can't deliver physical metal anymore. Here's cash instead. Good luck buying metal on the street at these prices. And if you think I'm being alarmist, let me remind you that in early January, Physical silver in Tokyo was trading at $130 per ounce when the paper price was in the 70s. Let me say that again. Physical metal, actual silver that you could hold in your hand, was selling for $130 while the paper contracts were showing $70. That's an 85% premium. That's not a market. That's a market in the process of breaking apart. And the fact that this is happening in multiple locations simultaneously, Tokyo, Shanghai, parts of the Middle East, tells you this isn't a local problem. This is a global structural failure of the paper-silver system. Now let me talk about the strategic implications of what China is doing, because this goes way beyond just silver prices. Silver isn't just a shiny metal that people collect, it's the most critical industrial metal in the modern economy. It's in every solar panel. It's in every smartphone. It's in electric vehicles. It's in 5G infrastructure. It's in advanced weapons systems. If you control the supply of silver, you control the supply chain for virtually every high-tech industry that matters. And China isn't stockpiling silver for fun. They're stockpiling it because they understand that in a world that's rapidly electrifying and digitizing, silver is as strategic as oil was in 1973. Maybe more strategic, because you can't easily substitute for silver's unique properties in many applications. The Trump administration's Section 232 declaration acknowledged this reality. They looked at the supply situation and realized the United States is critically dependent on imported silver. And most of that import chain runs through or originates from China. When your adversary controls 60 to 70% of globally traded refined silver, and they implement export restrictions right as industrial demand is exploding, that's not a market issue, that's a national security crisis. And Trump's response, threatening reciprocal tariffs and 100% tariffs, is essentially economic retaliation. But here's the problem. Tariffs don't create silver. Tariffs don't refill empty vaults. All tariffs can do is make it more expensive to import metal that you don't have domestic sources for. It's a defensive move that doesn't solve the underlying problem, which is that the physical metal is disappearing and it's not coming back. Let's talk about what this means for your portfolio and your wealth. I don't care if you have $10,000 or $10 million. If you're holding paper assets denominated in dollars and you have zero exposure to physical precious metals, you are exposed to a risk that most financial advisors either don't understand or won't tell you about. When governments resort to calling things national emergencies and threatening 100% tariffs, that's your signal that the system is under stress. That's your warning that the playbook you thought you could trust, buy stocks, buy bonds, diversify across paper assets, that playbook is about to stop working. Physical silver, and I mean metal you can hold or metal stored in allocated form where you have direct title to specific bars with serial numbers, is how you opt out of the paper system. It's how you protect yourself from the scenario where the arbitrage continues, the vaults drain, and suddenly there's a disconnect between the price on your screen and the price you'd have to pay to actually acquire metal. I've been harping on this throughout this video, and I'll say it one more time because repetition is how important information sticks. Paper silver is a derivative of silver. It's a claim that's only as good as the institution making the promise and the physical inventory backing that promise. Physical silver is the metal itself. One of those survives a crisis, the other one doesn't. Now I want to address the elephant in the room. Some of you watching this are thinking, okay, this sounds serious, but silver is already at $120. Didn't I miss the boat? Shouldn't I wait for a pullback? Let me tell you why that thinking is exactly backwards right now. When a market is in a supply crisis, pullbacks don't happen the way they do in normal markets. Yes, silver could drop $10 tomorrow on some news event or profit-taking. But if the structural dynamics I've described are in play, if the vaults are continuing to drain, if China is maintaining that premium, if industrial and investment demand continues to grow, then any pullback is going to be shallow and brief before the upward pressure resumes. You're not waiting for a better price. You're waiting for physical availability to disappear. Think about it logically. If you wait for silver to drop from $120 to $110 to feel better about your entry price, but by the time it hits $110 your dealer has no inventory, or your dealer is charging a $20 premium over spot because supply is so tight, what have you gained? Nothing. You've actually lost because you had an opportunity to acquire metal at elevated but still available prices, and you passed on it, hoping for a better deal that never materialized. The smart money doesn't try to time markets in crisis. The smart money identifies when a structural shift is occurring and acts before the crowd figures it out. Right now, today, you can still call major dealers and buy silver. You'll pay premiums over spot, sure, but you can get it 6 months from now. Will that still be true? I don't know, and neither do you. But the trends suggest that availability is going to get worse, not better. Here's what I think is going to happen over the next several months. The arbitrage between Shanghai and Western markets continues as long as China maintains their export restrictions. COMEX inventory continues to drain. At some point, probably within the next 60 to 90 days, you're going to see delivery failures or force majeure declarations on the futures exchange. That's when the real panic starts, because that's when the mainstream financial media finally pays attention and tells millions of people that there's a silver shortage. And those millions of people are going to do what people always do in a shortage. They're going to panic buy. And when that wave of demand hits a supply situation that's already critically tight, you're going to see prices that make today's $120 look cheap. I'm not saying silver goes to $200 next month. I don't have a crystal ball. But I am saying that the setup for a major move higher is better now than it's been in 40 years. The physical supply situation is tighter. The geopolitical weaponization is more aggressive. The industrial demand is higher, and the gap between paper claims and physical metal is wider. Every single factor that creates explosive price moves is lining up simultaneously. And let me bring this full circle to the Trump tariff situation, because that's going to be a catalyst that accelerates everything I just described. When the United States starts imposing 100% tariffs on critical mineral imports, whether that's from China directly or from third countries that are acting as pass-throughs, what do you think happens to domestic prices? They spike. Not because there's more demand, but because there's less supply. And when prices spike due to supply restrictions, that creates even more urgency for people to acquire physical metal before it gets even more expensive or completely unavailable. It's a self-fulfilling prophecy. The tariffs that are meant to protect strategic supply actually accelerate the supply crisis by creating hoarding behavior. China understands this dynamic. That's why they made their move on January 1st with the export licensing. They knew it would take the US several months to respond. And by the time the response came, the arbitrage would have already drained massive amounts of metal eastward. They were right. The Section 232 declaration didn't come until January 14th. 2 full weeks after the Chinese controls took effect, and even now, the actual tariff implementation is still being negotiated. By the time 100% tariffs are actually in place, if they ever are, the damage will already be done, the metal will be gone, the vaults will be depleted, and the paper-silver market will be exposed as the fractionally reserved house of cards that it's always been. I want to share one more piece of evidence that this is all connected and coordinated. On January 27th, Bloomberg reported that silver's rally is being fueled by broad demand and physical tightness, and they specifically cited Chinese buyers creating a widening premium in Shanghai. Business Insider reported the same day that Chinese demand has pushed Shanghai premiums to record highs above $14 over London. These aren't fringe websites or conspiracy theorists. This is mainstream financial media confirming exactly what I'm telling you. The premium exists. The arbitrage is happening. The vaults are draining, and it's all connected to China's export restrictions that just took effect less than 30 days ago. Now here's what you need to do. First, if you haven't already, subscribe to this channel and turn on notifications because this story is going to develop rapidly and you need to stay informed. Second, leave me a comment with your location and what time it is where you are. I want to see how widely this message is spreading. And third, ask yourself honestly, what percentage of my wealth is in physical assets that can't be printed, devalued, or confiscated through inflation or currency controls? If that answer is 0, or if it's less than 5%, you need to rethink your strategy immediately. I'm not telling you to put everything into silver. I'm not giving you financial advice. What I'm doing is showing you data and trends that the mainstream isn't covering adequately. And I'm asking you to think critically about what happens if these trends continue. Because if they do continue, if the vaults keep draining, if China maintains their premium, if Trump escalates with massive tariffs, we're looking at a silver market that could become completely dysfunctional within months. And in that environment, the people holding paper promises are going to learn a very expensive lesson about counterparty risk. while the people holding physical metal are going to be sitting on one of the best performing assets of the decade. The difference between paper and physical silver isn't just academic. It's the difference between owning something and owning a promise that someone will give you something. And when the system breaks, those promises evaporate. I've said this 5 times now, in different ways throughout this video, because it's the most important thing you need to understand. Physical metal that you control, either in your possession or in allocated storage where you have direct title, is real. Everything else is a derivative that depends on the integrity and solvency of institutions that are currently watching their inventories disappear. The $125 premium that China has engineered isn't going away. It's a tool of economic warfare, and it's working exactly as intended. The arbitrage is draining Western vaults. The supply situation is getting tighter by the day. Trump's response confirms that the U.S. government recognizes the threat but doesn't have effective tools to stop it. And all of this is happening while industrial demand for silver is at record. The highs are projected to go even higher as solar, EVs, and AI infrastructure continue to scale. This is the setup. This is your warning. This is the moment when you have information and opportunity that won't last forever. 6 months from now, you're going to look back at $120 silver with dealer premiums of $5 to $8, and you're going to wish you had acted, or you're going to look back and be grateful you did. That choice is yours, but you can't say you weren't told. Subscribe, comment your location and time, and stay tuned because this story is far from over. Trump's tariffs are just the beginning of what's going to be a very volatile and very consequential period for precious metals. The weaponization has been confirmed. The vaults are draining. The premium is real. Now the question is, what are you going to do about it?